All right, JD, thank you so much for coming on.
Alec, thank you for having me. It's a pleasure to be here.
Absolutely. Can you tell us a little bit about yourself, how you got into the business you're in, and all of those good things?
Absolutely. Yeah. So my name is JD Gonzalez. I'm a certified financial planner. I'm a financial planner at Cameron Downing, a registered investment advisory firm based here in Miami. We do a lot of financial planning for clients. We also manage dollars on their behalf, and we do some insurance work as well. But we're a big financial planning first shop. A lot of investment managers start with investing. We're of the belief that you need to reverse engineer the purpose for those dollars. So, very big on comprehensive, fee only financial planning. And we do have the investment management arm as well. We are 3 certified financial planners, and we have an estate planning attorney in house as well. It's very valuable for clients to be able to do all of that work in one place. But I've been in the business for, geez, let's see, my first day was March 30th of 2020. So day one in my financial career, we worked out of one of the partners' homes for a couple of days with the lockdowns. That was day one of the lockdowns. So joined this team, been working with them now for 4.5 years. I made partner last year, so I'm an equity owner of the firm. And it's been a wild ride, man. It's been a wild ride. A career in the financial services industry that started at the bottom of the market during COVID, and then everything else that's happened since. So it's been a great career, wonderful career. Certainly excited for everything else that's to come.
So, what is a certified financial planner? Like, what is your day to day? What do you do for people? I think we have a lot of real estate people watching right now, so they may not understand that. Could you give us a little insight on like your day to day and what you would do if somebody came to you and said, "Hey, I need help"?
Sure, yeah. So we work with primarily 4 distinct client profiles: young professionals like ourselves, business owners or employees in tech, the common variable there being equity via compensation or outright ownership. Uh, we work with a lot of attorneys, and we also help clients retire. So, what is financial planning? Financial advisor is a term that's loosely thrown around. In fact, the CFP board is trying to change that so that you have to have XYZ credentials to call yourself an advisor. But financial advisors are typically associated with what's going to happen next in my stock portfolio, and that's not exactly the purview of our work. Our day to day is helping clients build roadmaps for those investment objectives, for those life goals. At the end of the day, it's a very qualitative result that you're obtaining through working with us. But it's the clarity, it's the confidence that all of your finances, when it top to bottom approach, we start with cash flow, get into everything risk management, keeping more of what you own. So be it tax efficiency, optimizing your taxes, insurances, the risks that are too expensive to pay for yourself, let's insure those. And then everything looking forward, right? So asset titling, beneficiaries, investment management, all of that stuff. So it's very much an advice-driven engagement. It's not a product. It's not an annuity. It's not an IUL. It's not an investment portfolio. It's the roadmap to help you achieve the desired outcome, whatever that looks like.
So, if somebody wants to retire early, let's say age 45 or something, they would come to you and you would kind of reverse engineer
Correct.
their income, their portfolio, whether real estate, whether it's stocks, whatever, and kind of back into, okay, this is how we can get you to retire early at age 45, if at all possible.
Correct. Correct. Now it comes back to what clients value, right? So I'm a big believer in deferred gratification, right? All good stuff is going to take a long time to get there. I know you share that belief,
Absolutely.
but it comes back to what people value. So we've worked with clients before that have the means to retire a lot earlier than most people, very enviably, but choose not to because they want to maintain a certain lifestyle through retirement or into retirement rather. And we have other people who, this is a very common case, for example, in the attorney profession, right? You go to law. If anybody understands deferred gratification, it's attorneys, right? You go to law school for 3 years, you got your undergrad behind you, you get that first big law job. I'm working with a client now, she's making a tremendous income. very young age, but she's working until 11:30 p.m. every single day. Attorney burnout is so real, it is a planning topic for us, right? Because most people do not last 30, 40 years in big law, right? So somebody like that, for example, might come to us and say, that's it, man, I'm done. Help me get out. Help me get out. And every client has their own preferences, right? Some clients, maybe a lot of the people you work with, Alec, are very real estate minded. There's a lot of different variables, a lot of different ways to achieve those returns. Hence, again, the service we offer is the roadmap. We can certainly help you implement it, and we'll come up with different ways to do it, but how you choose to implement that is completely up to what your preferences are.
Sure. That's one of the reasons I'm so excited to have you on here, is just to get that different view. You know
Sure.
what I mean? Like, I spit real estate all day, every day to these guys, and a lot of people that I follow do, and there's 8,000 or more or less 80,000 realtors in Miami just
Sure.
spitting real estate. So I'm excited to have kind of that different aspect and help people understand that there is a different avenue, there is a different path, a more liquid path maybe.
Certainly, yeah.
So yeah, just it's all interesting to hear kind of your space as a real estate profession, because it is part of a portfolio. I've read a lot of books on like Pioneering Portfolio Management by David Swenson. So he did Yale's Endowment.
That's
that
an
was a
OG
super
book.
interesting book.
Yeah.
Like all about balance and being diversified is his whole thesis. So that was super cool. But
I read once, actually through my studies right now, I'm working on another designation, but the content went through, the younger you are, the statistically more likely that your assets, whichever they are highly concentrated. And as age and net worth increase, only then do you see the stats to say, okay, for some reason people think that I'm at $1 million, now it's time to diversify. There's pros and cons to it, right? From our point of view, we think coming across lump sums, right, having these big liquidating events, right, and so forth, a big property sale or whatever, when you're sitting on a lot of cash, it's hard to come by a lump sum like that again. So our objective is to preserve that. In doing so, you want to, if that is your objective, you want to diversify. I also work with a lot of people who are employees in tech, for example, and who will push back and say, JD, I wouldn't be where I am today if it wasn't for what is essentially a calculated risk, right? Is I can stomach having 90% of my net worth tied up with one security or one property or whatever. Yeah, it is. But the data's there, man. The data's there. The younger we are and the higher our net worth is now, the more concentration is a risk. Which again makes sense, right? As you go through the different stages of your financial life, when you get to retirement, it's preservation. And that's when people click and say, now is time to diversify. So different schools of thoughts, different ways to get there. But when we work with any investment client, it starts with risk. It starts with, and our job is, of course, as advisors to condense the math for you. You're hiring us because you don't want to have to worry about within how many standard deviations is my portfolio. They just want to know, am I going to be okay? And number two, what does the ride there look like, right? The glide path of whatever your investments are. I'm sure you've seen people take outsized risks that worked out well for them. There's a lot of stories about it not working out,
Yes, sir.
Well, I can tell you if you'd like about this designation.
Yes.
Yeah.
Okay, tell us.
So I obtained my Certified Financial Planner designation August of 2022. Okay. So it's, you got to have your bachelor's for it. It's a master's level coursework. Takes different people, different amounts of time. It took me about 1.5 years to complete with all of my other responsibilities. That's what enabled me to maintain my own clients at our firm. It's really just, step out onto my own and start working with households and families directly. But now I'm working to complement that and really bolster our investment management. So I'm at the Yale School of Management right now, working on my CIMA, the Certified Investment Management Analyst designation. It's been a very valuable coursework, very, very fascinating stuff. Again, on that numbers side of the equation. But the best advisors are the ones that have that and compute things like that, but that can, converse it to a client in a much more English way, if that makes sense.
Sure. So what exactly is SEMA again?
So the Certified Investment Management Analyst designation is for portfolio managers.
Okay.
And it's a little different than, for example, the CFA, for example. That's the one that's very popularly tossed around. My opinion is the CFA is it's a beast of an exam. I think when I first started working in the industry, that year's passing rate was like 26%. Like it was abysmal. It was a very difficult exam. There's 4 stages to the exam before you can be a charter holder. But it's very, very valuations intensive. It's extremely math intensive for sure. But it's very useful, in my opinion, first and foremost for institutional money management. So if you were, say, at the Morgan Stanleys of the world where you're this big behemoth of a portfolio manager and these decisions require XYZ level of credibility. But the SEMA is kind of that sweet spot in between where it's designed not with the objective of serving the institution, but with the objective of serving the client. So it's very much oriented, like I said earlier, into, it's not just here, all this math for you. It's very much, okay, now use it in a client example, right? How does this apply? How would you communicate your findings to the client? And how can you use those understandings to make better investment decisions for clients? You know, you and I, when we were talking earlier, we talked about, for example, a client who was thinking of making a real estate purchase, right? And then decided against it. This professor, he's been at PIMCO for a very long time. PIMCO, of course, is big on real estate, but
What's PIMCO?
PIMCO's an institution, investment institution. They do a lot of different stuff. They're big on like REITs and things like that, but they're also the broker for fixed income stuff. That's their bread and butter. But our office building, for example, PIMCO Nuveen is on the outside. PIMCO is a very large institution. But he's been at PIMCO for a long time, and one of his examples was understanding very simple rates of returns, right? And how that varies in different asset classes, how that might look different from a fixed income instrument, a stock portfolio, or a real estate portfolio. And he gave an example of a case. Guy was thinking of making a $50 million real estate purchase. And when they got under the hood and they said, hey, listen, this is how much you're going to pay for this type of return, the client immediately said, okay, next. Right?
We're not investing in
We're not investing in this. We're not investing in this. Man, I'm a firm believer in real estate. I truly am. I'm excited at the prospect of you know, you and one of your previous guests, Alex, is getting those first couple of units, doing the property management myself, eventually, hopefully outsourcing that. But it's not just get on this rocket ship and it's going to take me up. You know, every investment is different. I might compare, you know, a stock in XYZ company to this company, where understanding the returns of this primary home, for example, is very different than the returns on a duplex or a multifamily unit, and understanding the mechanics of those returns. And again, making sure that a rather big purchase is going to be for a net positive, right? Real estate is, you've said it yourself, Alex. What is it that you say? It's glamorous and glitzy?
Something
along those lines. That's how it's pushed, man. That's how it's pushed. Got nothing bad to say about real estate. Firmly believe that for the right investor, diversifying into that type of asset class could be a tremendous benefit. Lots of different ways to do so, but knowing what you're buying and knowing, like Warren Buffett might say, right? Know what you're invested in. And it comes back to that. It's knowing what the returns on your property are going to look like. Is there a better avenue? Is there a different investment? Or do I want to just go in a different direction?
So what do you think the reason is, at least on the real estate side? There's a lot of people that are in real estate, realtors, brokers, whatever. And they look at the financial planners and they kind of look at them as opposition.
Sure.
Which I think is interesting, because a lot of the time I hear those financial planners say, oh, real estate isn't a good idea. But I understand now that you're not just saying real estate isn't a good idea because you don't like it. It's because for that client's plan, or whatever the case may be,
right,
it might not be the right pathway.
Correct.
So I'm understanding that now. But I think the industry as a whole, or just realtors, like I said before, as like we kind of look at y'all and like, hey, they're trying to get our clients to not purchase
Sure.
for XYZ.
Yeah.
So what's your take on that? Like, where do you think that comes from and stems from?
Yeah.
What's your thoughts?
I understand why realtors might push back on financial planners and say that we're moving them away or moving them against it. I've got several different client stories that play into both sides of that equation. So first and foremost, as a CFP, we're held to a fiduciary standard of care. What does that mean? It means that our recommendations are given with the client's best interests in mind. Not a commission, not a particular product, not a particular investment. The objective is the client's needs above anyone else's. That said, realtors work on commission. From our point of view, that presents itself a conflict of interest. So,
Hey, now with the new laws that came into place, there might not
sure,
be any
there
violation
might be some changes. There might be some changes there, and we're definitely keeping an eye on it.
It's going to be interesting to see how that shakes out, but
Absolutely.
it's going to be wild.
Absolutely.
Sorry to interject.
No, not at all. And it's a great point. If it does change where it's more consumer oriented or with their interests in mind first, I think that's a great positive change for the industry as a whole. I truly think so. I think, heck, even in our industry, we've seen a shift and we've seen people asking those questions that I talked about earlier. Like, man, I don't have $1 million to invest. Morgan Stanley or XYZ firm might not take me if I don't have this amount of capital. But I still have so many questions outside of my investment portfolio, right? That's just a small component of your financial plan. So
is that actually a thing that Morgan Stanley and those companies won't take you if you have less than X amount?
Well, it absolutely is.
What's that
We have, every firm works a little differently. There's the ultra high net worths that don't talk to you unless you're a family office with 50 million and above. And then all the way down the market, there's all sorts of different options. We work with clients, we do have investment minimums, but they're 250,000.
Okay.
So we're looking to work with that middle market.
Sure.
And again, with our service, ideally find the people that are asking themselves that question. Like, man, I'm interested in that, but I don't have the capital, but how do I get access to that?
Sure.
Right? So anyways, to your question, Alec, I think a commission-based compensation can sometimes lead to a conflict of interest, right? Because whether or not that real estate purchase is the best one for the client, a realtor might not necessarily care. They're just going for their 3%. Right?
So realtors versus financial planners.
Yeah, so Alec, we were talking earlier about, realtors being at odds with financial planners. So, I gave you some examples about a client where the property purchase just didn't make sense, right? And I'm telling you, if this client had pulled the trigger on her property purchase, she would be, like you said earlier, house poor, right? Asset rich, cash flow is really, really, really tight, if not negative. From our point of view, we're often kind of considered sometimes the quarterback of the client's financial team. Our best engagements are when we're able to collaborate actively with CPAs, with attorneys. Again, part of the reason why we brought an attorney in-house was to bring that perspective into client meetings. When we're talking about real estate, how you own it is everything, right? And an attorney will help you with that. But we're at odds because sometimes clients do in fact look to us for the green light to make that purchase. And if the answer is no, then
You're the bad
obviously
guy.
we're the bad guy.
Mm-hmm.
We're the bad guy. But for example, I'm on the board of the Financial Planning Association this year. And one of our board members is a very successful realtor out of Sotheby's. And if you ask her, all of her referrals come from advisors. So it goes both ways, Alec, it really does. It's just, again, with the client's best interest in mind, if they cannot fathom, we're talking very simply here, the income and expenses of maintaining a house, but we talked about a new roof. We talked about the emergency expenses. That is for the property itself. You could have these at any time personally. Life will throw whatever it wants to your way. But if you're not ready to handle the risks, right? If you're not ready to handle the time invested into it, if you're going to be an individual property manager, if you don't understand all of the question marks, all of the big variables that come into play with this asset class, then that's exactly when we'll tell a client, hey, it doesn't make sense.
So as we're talking here, things are running through my mind. And first and foremost is, I think so many people in real estate get started super risky. Super risky. Like my mom got started super risky. like a lot of the big, like Ryan Pineda, for example, big real estate guy on social media, started super risky, maxing out credit cards to go and purchase real estate. So when y'all come in and you're like, hey, we're ultra conservative, we require 6 months reserves, we got to do it this way, we got to do it that way. I understand it. Like I'm an open-minded guy,
Sure.
right? Like I understand where you're coming from. I know it's probably a more calculated plan with less risk and all these things. But I think there might be a lot of conflicts because I got started and I was broke and I was barely floating it. And like if something happened, I had to ask family for help or whatever the case may be. And a lot of people get started that way in real estate. And then a lot of people look at that maybe aren't in the real estate game yet and like want to be, then if y'all are telling them no, but we've had this experience and now like we're trying to communicate that, they've got two opposing forces trying to communicate. Which one's the right way? Who knows? Who knows? You know what I mean?
Look, I'm not going to tell you that we're the ones that are in the right at all times, but we always ask clients this, how much better would your outlook on life be if you had $50,000 in cash sitting in the bank?
Absolutely, but would I have a couple million in equity?
Of course.
No.
So it's a pluses and minuses, right? It's the pluses and minuses. So we want to, again, we'll start with that kind of qualitative. And I posted about this the other week. So our office overlooks the Miami International Airport. So we're up to here.
Are you in Blue Lagoon?
Yeah.
Oh.
So we're up to here with airplane analogies. One of the ones that we'll share with clients is that people don't buy plane tickets to ride a plane. They're buying the destination, right? So when we start that discovery meeting, Alec, what is the destination? Where do you want us to go with all of this, right? What is that end result and what does it look like? Give me the details. I want to know it all. Mm-hmm. From there, we start working the numbers. We've had client engagements where we start off on that tone, and then once they see what the numbers look like, we have to change course, right? I worked with somebody last year who's a good friend of mine, started off as a PA, right? And went and is working on that property purchase. But we had to reshift the plan because, hey, the student loans, right? Somebody might be way more debt averse than someone else. So his prerogative at first was get me out of the student loans as fast as possible. You've got to put your life on hold to make that happen, right?
So what I would say is invest in real estate, flip one property, make $100,000 on a flip, and pay off your student loans.
Not
you know
everybody.
what I'm saying?
Of course.
You know
of
what I'm
course,
saying?
Of course.
I'm just rebuttaling.
But that's a risk, is it not?
It's a very big
so
risk.
So our job is first and foremost, forget about returns. It's about managing risk, right? So that's where we talked about the insurance. That's where we talked about how do you own a property, right? Keep it inside of an LLC. Heck, we had a client recently who was working on a property purchase. He had the green light from us. We told him to go and buy it in cash because he could. In our final recommendations, we told him liability insurance is a must for this type of venture. A week later, his housekeeper slips and falls. Big question mark.
Lawsuit?
Right? Lots of risk. So
is he getting sued right now?
No, not at the moment.
Okay.
Not at the moment.
But it's a
question mark.
It's a question
mark. But again, it's not so much to talk about this instance as much as it is look at the can of worms that you've opened with this type of purchase. So thankfully, your flip went well, right? And you were able to get in at a good price. The market did phenomenal. Prices appreciated, supply and demand, you name it. The flip worked out. But I know people who buy real estate and sell it 5 years later and are negative for those 5 years.
Sure.
So it really comes back to, like you said, understanding the investment. If you're going to take the risk, let's do it calculated, right? Let's do it in a way where let's assume shit hits the fan. Is everything else going to be okay? So you want those controlled environments. You want those calculated risks. So yeah, somebody with your type of expertise might be able to very easily put his hands on a quick flip where you might make that kind of money. But the average investor might not.
Sure.
The average investor might not. And that's why we're being hired in the first place. That's why you're being hired in the first place. It's because you bring something above and beyond your fee, right? You bring a certain value and a certain perspective to the equation that is going to facilitate that outcome. With that said, Alec, I'll tell you, I think we're right. I really do. I really do. Because it's not a easily enough repeatable process, what you're describing, where I could confidently tell someone and risk my CFP on buy this house, flip it in a year, you're going to cover your student loans. we can't take that. We can't give a recommendation like that because it might not happen. So what is a more conservative case? Well, now he's on a different type of repayment plan that's going to afford him the ability to still save a ton of money and be able to buy his first property. A different instance, for example, a gentleman, mid-50s, has his eyes set on retiring in the next decade or so. He's sitting on XYZ Capital. And we talked to him, he's a GC, right? So he's in this world, he knows it very well. He knows all those ins and outs. He knows about, I'm gonna build it from the ground up and make that 30, 40% ROI that you were talking about the other day. We talked him out of it. Because he is winding down from this GC business of his, right? He wants to, we don't like to say retirement, we like to say work optional, right? Sure. At what point do you have that ability to say, I can go into work today or I can't, or I don't want to, rather. He was looking to wind down. And he thought, you know what, my retirement, to start, I'm gonna put all this into real estate. And we talked him out of it because number one, we know the client and what his wants and needs are outside of a return. We know the quality of life he's going for, and we know what the numbers are on the property that he was looking at. We put him in, fixed income these days is, the Fed might lower rates soon, but right now we're getting as many clients into individual bonds as we can. For the right investor, locking 7-8% for the next foreseeable 7, 8, 9 years is not a bad investment for that type of risk profile. Sure. And again, for us, it's a couple of clicks, right? Guy doesn't have to worry about getting sued from a tenant. Guy doesn't have to worry about pipes bursting or making trips to, you were talking plumbers near me. He doesn't have to worry about any of that, right? For a similar ROI. Heck, he gave up a couple of basis points, but he knew that, A and B, right? Very different scenarios.
Yeah. Can you dive a little bit, so there's a big question mark right now, from my understanding, in your industry as far as like the 2% or whatever fee that you guys make off of the AUM. I think that's how it works, right? So let's say you have $1 million under management, you get a 2% per year.
So 2% is
on that,
really steep. 2% is more in like the hedge fund world, right? That really aggressive, you're paying us a very high fee, or relative to the market, a higher fee than usual, because we know something that you don't, right? That's the premise. Whether or not they are able to deliver on that is a whole different question, but in any case, that 2%, the 2 and 20 as it's called, where they'll take 2% base and 20% of the performance, right? So they'll even have a hurdle where if we make you above 10%, we're keeping 20% of it. Very performance driven, expensive investment management, not for everybody. You got to be an accredited investor. That's not where most people are starting. The retail investor typically starts with public markets, the stock market. So our fee is 1.25% on the first $500,000. Okay. After that, it starts tiering down.
So 1.25 on 500,000 and
right.
below.
1% on 500 to $1 million, and again, it keeps tapering off. 75 basis points, 70, all the way down to 50.
Okay.
So it depends on how many assets we're managing. That said, because of our prerogative of financial planning, we are not, robo-advisors. A lot of people come to us from the big wirehouses because they're tired of the 1-800 customer service phone number. You pick up you call our office, you know exactly who's going to pick up the phone. It is a lot more personal, and because there's that big financial planning element, that's why our fee might be, compared to the rest of the market, marginally higher. A lot of people will charge maybe 75 basis points to get in with the first $1 million or something like that. Every RIA does it differently, but that's where we're priced. And again, the reason for that price is because of everything financial planning. So we'll take on a client's portfolio and we'll manage it for years at a time, but we're meeting with the client twice a year, once a year, for everything outside of their investment portfolio as well. So we're coordinating with the CPAs. We're doing tax planning, projections, figuring out what the tax bill is going to be, not in the next year, but in 5 years, right? Working on clients' beneficiaries, insurances, just making sure that the plan and that the course that we've charted is ongoing, right? So that's the difference between a financial plan, I deliver a plan to you today, and planning, because life is dynamic, right? So changing for that. So it's very much a financial planning kind of fee that's tucked into the AUM, if you will.
I think it's interesting right now that both of our commissions are under scrutiny.
Sure.
Like real estate's getting crushed on the buyer side. I think a lot of people have been talking about, oh, should I have my money with a financial planner that's charging this? You know that guy who did that Netflix show, Ramit, or David Down Ramit or something?
It doesn't ring a bell though. Was it the money?
Money Talks or something,
yeah.
maybe. I can't remember, but he's like, do not put it in with a financial planner, all this stuff.
Yeah, they'll show you what 1% is over 20 years and tell you, look at how much you paid this person.
But then it doesn't take into account the amount of work that you've done and all these things. So what's your take on, I guess, the scrutiny that fee is receiving?
Sure.
And where do you think it's going to go? I look at it as big institutions trying to cut out like middlemen almost. Or I don't know how to put it, but like I feel like we're being devalued, which is interesting.
It is, Alec. And you know, as an advisor, right, in different ways, but we both are, you never, forget it being an advisor, you never want to have people questioning that value above and beyond the price that you're bringing to the table, right? It's almost kind of like, but some clients warrant being reminded, right? Let me backtrack for a second. 100% fee compression has happened and I think continues to happen. I think we've seen, I mentioned earlier, the big changes in the industry. We've seen minimums come down. We've seen the fees.
Nobody has any money.
We've seen the fees. We've seen the fees come down as well. A lot of regulation around what is a justifiable fee, and like all sorts of red flags come up if you're charging above those thresholds. We've also seen a big change away from that strictly AUM conversation, the assets under management, to be more fee-only advice-driven engagements. Like I said, a lot of people have those questions, but don't have $1 million to invest. And if that's the cost to get in, a lot of people are left out, right? So check it out on our website. Our financial plans are very transparently priced. You know exactly what you're going to pay. You know exactly what you're going to get. AUM, if you are the type of advisor, if you're a client with an advisor, and you're being charged these AUM fees, and you hear from your advisor maybe once a year, or if you have a question, you got to dial a 1-800 number. Yeah. For sure. That's I can see how that might warrant, well, what am I paying for here outside of you managing my portfolio? Not to belittle that, because it is a very intensive task and people think it's just buy and hold for the rest of your life and you'll be okay. That might work, but we're not of that camp. So for example, we had a client recently who asked us this and said, hey, look, there's this robo-advisory firm that's going to charge me half of what you charge me. Why don't I move my dollars over there? We're like, easy. And we put a list of all the things that we worked on for her above and beyond that portfolio. This is a client actually that we helped transition through a 1031 into a Delaware statutory trust. This is a client for which we did a lot of estate planning updates, right? This client, in fact, she had the majority of her assets going to an ex-husband, right? So things like that go outside of the portfolio. Sometimes clients do need to be reminded. It's not the easiest of conversations for sure when people push back on your fee.
I think it's important people understand what else is out there too. Like
an
intelligent client, like if I'm going to a doctor, for example, I'm calling 4 different doctors.
Oh, I want to be asked about it.
Like, you know what I'm saying? Like,
for sure.
So I don't think them asking is bad. And when people talk to me about that, I want them to ask. I want them to be educated. I want them to be certain in their decision. So like just a little interjection there is like, I think that's
I agree. I think it's a healthy conversation to have is again, it's putting up your livelihood, if you will, up to the light, right? And saying, justify this. If you can justify it, excellent, you're okay. It was just a constructive conversation.
Absolutely.
We had a client come to us actually because we were more expensive, and we told him why we're more expensive. And he goes, that's what I wanted to hear.
Yeah.
And that client worked with us and still is.
That's
so
amazing.
It absolutely can be helpful. In fact, just last week I was having a consultation with a prospective client. He's interviewing different advisors. I think that's excellent. I think this is somebody that you're going to bring into your life, like we've talked about, in a very personal, Alec, people don't talk about their dollars and their finances with their best friends after 10 drinks, right? That's not something that comes up easy. So if you're going to go through that, find the advisor that is going to best match your personality, your objectives, your needs, your risk profile, right? different advisors might tell you, JD, I think what you said earlier about having XYZ requirements met before buying a primary home are moot, because like Alec, I think you can get a tremendous return. Everyone's going to look at it a little bit differently.
Yeah.
It's not a math, it's an art and a science very much. So having those conversations with clients about what you're bringing to the table, who you are as an advisor, and finding that ideal candidate is just as important as it is for you and me to screen for and work with people, like you said, that aren't going to have second guesses about this entire service 2 months down the line, because I'd rather you just tell me no from the beginning. But yeah, absolutely. I think it's a wonderful conversation to have. I think if you're able to justify your fee honestly and truly to the client, then you absolutely deserve it.
So can you tell, I guess, the audience and myself a little bit, and this is a learning point for me too, what are the biggest hurdles that you're like overcoming, or objections you're overcoming right now in your industry? Is it trading at like Robinhood and all of those things? Like, are a lot of people going directly to that, or can you dive into that a little bit?
Sure. So I genuinely believe everyone should have a financial plan for themselves at some point or another of their life. I think sometimes people want it but aren't ready for that type of engagement, for that type of unearthing of finances. It can be a little bit of a scrutinous kind of process. So going through that, maybe someone isn't ready. But as far as the financial planning goes, I think either a client is ready for it or they're not, but it's always a good outcome, right? Investment management, on the other hand, sure, we've seen a lot of, markets are always uncertain. Nobody can tell you what's going to happen tomorrow, but there are a lot of question marks around the broader markets right now. There's concerns about stretched valuations. Now, last week, with all the volatility, that whipsaw we saw, markets had their worst day in over a year on Monday, and then markets had their best day in since November of last year on Thursday, right? So it was a whipsaw of volatility last week, and there's a lot of questions about, is a recession coming? So when it comes to investment management, of course, a huge determinant of a client's returns is the price they pay for that investment. So is the market overvalued? Timing. Which brings in a second point. I think trying to time the market is a fool's game, right? So if you are a long-term investor and we know the objective for these dollars is very much down the horizon, I don't think there is a bad time to get into the market. That's my personal opinion. But as far as objections with clients, I really think it just comes back to whether or not they're ready for that type of service. So we call ourselves personal trainers for your money, right? And we're very intent or very carefully crafted that analogy because it draws, we think, a very solid parallel. We are not here to just, here's the answer, go on your way. If you want that desired outcome, it's going to take work. We will reverse engineer all the numbers, but for the numbers to number, you're going to need to, make some adjustments or take the recommendations, which we talked about earlier. Behavior can be hard to change, but nonetheless, it is a byproduct of a financial plan. So whether or not a client is ready for it and is really looking for that type of comprehensive service, right? Because it's also happened before where I've had people reach out to me and they're saying, JD, I just have a question with this, and we don't work on answering this, right? Like we either,
because there's so much other stuff involved, right?
Because there's so much other stuff involved. Like I can't in good faith tell you what to do with your portfolio today. I might have some very objective, like, hey, your risk reward looks off and this looks like a lot of risk for what you've told me, but I can't in good faith make a recommendation knowing that the implications of that change are going to go into all the different facets of a client's financial life.
Sure.
Right? So people...
That's like when people come and say, hey, I want to buy some real estate, what should I do? I'm like, okay, well, do you want tax benefits? Do you want cash flow? Do you want appreciation? It's the same thing. It's like a scenario-based answer is what you have to give based on what they need.
Exactly. No, a financial planner's favorite phrase is it depends, right?
But that's not what they want to hear because I feel like
It's not, which is why it's a very interesting dynamic. And I've found this to be the case more and more with the higher net worth clients. A lot of people at those thresholds really just want to dude, I don't want to worry about it. Take care of it, right? When we're working with that amount of capital, those types of inputs,
What do you consider high net worth? Or like when you said that, what do you mean? How much?
probably Alec above 5 million,
Okay.
right? Net worth, right?
Sure.
Not AUM, not XYZ real estate holding. It's taken as a whole, right? I think that net worth really starts opening the doors for it lends itself to saying, JD, just take care of this, right? Because there's that much more to work with. But when you have a client who says starting off, right, this PA client that I mentioned, young guy, hardworking guy, just got out of school, big student loans, but has all the earnings potential in the world. We're starting from the ground up. We're starting from the ground up, and I think that's exactly who we're trying to serve, right? So it has happened where these higher net worth clients just come and say, look, take care of this.
Well, if they make 10% on 5 million, that's 500,000 a year.
Sure.
So it's like, just for the audience, maybe they, like, if you have 5 million in liquid market, and what's the average return you'd say?
It depends, right?
Yeah.
It depends on the type of investments that you're in, but
Let's say you make 5%.
say a very
even.
conservative 5-6%.
5%, that's 250,000 a year.
Right.
So like
right.
that's once you have that amount of money, life becomes quite a bit different.
Quite a bit different, right? Money begets more money. But again, those personal trainer type of engagements that we have come from, or tend to come more from the people who are building rather than I've built everything
Yeah.
I'm going to build, take care of it.
Sure.
Those are very different types of needs.
So can you talk directly on like Robinhood and like all those investing platforms?
Sure.
Can you give me just some thoughts, opinions? I personally don't do it. I know some people that have done it and they're like this and that. They've lost a bunch of money. Some
Sure.
people have made a significant amount of money. What's your thoughts?
I think trading is, to your words, glamorous and glitzy. I think 95% of traders are not operating profitably. In fact,
Wait, you said 95% or
95%. So you see all these courses. I
was
bet
gonna
you
say, dude,
more
every
money.
course.
These traders are making more money selling their courses than they are actually trading.
Courses are so profitable.
Absolutely,
once,
as a model,
and it's passive
yeah,
income.
100%,
It's like-
100%. Fool me once, that's
Yeah,
it.
yeah.
Just once, and you make it priced enough where it's
Yeah.
like, I just lost my money. But look, I'll take it a step further.
Yeah.
Let's forget retail clients, active managers, active institutional money managers, the people who we are assuming have all the credentials in the world, the CFAs, the CMT, the market technicians, all that stuff. There's a really interesting report that gets published every year by the S&P and Dow Jones indices called the SPIVA report. And it shows you by asset class or by type of investment, how many active managers fell beneath their benchmark.
Majority, right?
95%.
That's what David
So
Swenson talks about
yeah,
in Pioneer
exactly.
Portfolio Management.
Exactly. So those 2%, those 2 and 20 fees that we talked about sometimes are not worth the money because the return just isn't there.
Sure.
The return just isn't there.
Sure.
And they're priced weird, right? Like if it's an illiquid investment, the mark to mark is not intraday. It happens whenever the prices get published. Things like that just make those types of investments a little harder to understand the performance of it. And that's the hedge funds. There are active investment funds, ETFs, that you can buy that are, again, just over the long term compared to the broader indices, just don't keep up, or to their own benchmark, in fact. Now, when we're talking about Robinhood, Alec, we touched on fee compression. I think Robinhood opened the door for that. I think Robinhood, if I'm not mistaken, were the first to roll out commission-free, no trading fees type of brokerage. All the big guys followed suit after that once they saw the amount of success, the amount of money that Robinhood brought in. Right?
Side note, Ken Griffin gets a piece of every trade on Robinhood.
Yes.
And I know, so he's Citadel. He's moving to Miami.
Yes.
Which I'm,
All
on the
for.
real estate
Yeah,
side, man,
yeah,
that's
yeah,
going to be
by
a
all means.
wild event. But anyway, so he gets a piece of every trade from Robinhood.
Sure.
So people that don't know that, now they know.
Yeah,
But
so
anyways.
here's another really interesting thing that I learned, Alec, is Robinhood is now publicly traded, right? They came out to market, they IPO'd. We got to understand a lot more about Robinhood as a business. Don't quote me on this, Alec, but if I'm not mistaken, Robinhood's data feeds, so like what people are buying and what people are selling, that data is also shared with big market movers, big brokerages, right? So let's talk trading for a second. Let's say we're gonna get real technical. We've drawn a support line here. That data that says that Alec and JD are waiting to buy NVIDIA at, not, what's it trading at today, 108, 107, not at 107, but at 100, all that gets sent to the bigger market movers, and they will plow through retail traders with those types of feeds, with that type of data, right? So they're able to say, okay, these guys want to buy here, I'm going to take it even lower, right? Like you cannot compete as a retail trader with an institution, the amount of dollars that are behind those.
Yeah.
So Robinhood, sure, it's for the people, right? As the name might suggest, commission free, no fee trading. That opened the door for a lot of the other big brokerages to do that type of model. In fact, at today's day and age, if you are paying commissions for trading, I would tell you to find a different brokerage because it's just that readily available. But there's also some wonky stuff going on behind the scenes with who's getting, who's making money off of this, because you can't be for the people for free and be a successful business, right? So where are you making your money? It's what I would tell anybody interviewing an advisor. How are you compensated, right? That is going to me, I'm a firm believer, follow the money for all, in all facets of life. So although Robinhood opened the door for this fee compression, I think there's a lot of question marks around how all that data is put together and shared with some of the bigger market movers.
Okay, that's interesting. I think a lot of people don't even realize that everything in life is based off of, like every decision ever is based off of money. Like some people think a nonprofit is like not there for making money. Rolex is a nonprofit.
Sure.
They are loaded.
Yeah.
So like Goodwill, nonprofit, loaded.
Yeah.
Like every single, so when you go back to talking about Robinhood can't be for the people and not make money, that's the case for everything.
Sure.
There's I don't even know of any, I guess, nonprofit, and some people would probably comment or whatever and send me stuff, but that truly is for the people and not looking at a profit.
Sure.
Now, there's nonprofits that look for government funding,
Right.
That's a whole background scenario, and a lot of people are like, no, like they're really nonprofit, like they're really doing this out of the kindness of their heart.
Yeah.
Odds are, probably not. They're probably getting some government funding back
All right,
there.
so
It's interesting.
my girlfriend has a nonprofit, so I'm going to watch my tongue here. But I think nonprofits maybe start off as good causes, but
Absolutely.
then as the money starts flowing in, it's very easy to misappropriate funds and buy myself a mansion on non-tax dollars, right? So I think, again, money, charge subject, I believe augments whatever is inside you, right? So if you had that nefarious kind of objective, even if in the back of your mind, and all of a sudden you find yourself managing this huge nonprofit and you're making $1 million decisions every day, let's make sure there's the proper checks and balances in place for sure.
Yeah.
For sure. Yeah, again, everything comes back to show me the money, Alec. So we talked about Robinhood, we talked about how they opened the door for that, but when we're talking about advisors or we're talking about realtors, how is that person compensated, I think is going to give you a better insight into what maybe are their motivations, right? So we talked about fee-only advice. So you pay me a very clean $4,000 or whatever that fee is for my advice, A-B transaction. There's the people who will do only AUM, for example, and then that is in of itself a conflict of interest, right? So I want to certainly make it known that when we told the client that I mentioned earlier, this real estate purchase is not the best, let's do it this way, that's a conflict of interest because I'm going to make money that you park with me versus the money that the real estate purchase might.
Let's break that down for them. So let's say if you're paid on an AUM basis, right? You get, let's just call it 1%, and they have $2 million with you.
Sure.
Right? If they take $1 million of that and go buy real estate,
my fee just got cut in half.
Half of your fee.
Sure.
So for the people watching, I think that's something important to understand is what you're saying is, hey, no, we're not worried about losing that fee. If this is the best interest of the client, we're going to go ahead and tell them to buy this property.
When a client calls me and says, liquidate this many dollars out of my portfolio because I'm finally going to buy that vacation property or that boat or whatever the case might be, and they told me about that so long ago, I'm excited for them. I'm happy to send the dollars out. If there are questions about, for example, hey, I'm taking out $200,000 to buy an annuity because somebody told me that an annuity or an IUL was the end-all be-all to my financial life. I might push back on it. I might tell you, yeah, it's a good tool, but only in XYZ scenarios. Yeah, but remember what you told me about your concerns with risk. If it's a numbers question, I'll certainly let the client know about that. But man, if it's to fund the goals of their life, I'm here for it, man. I'm here for it. I'm happy to do that. It is a conflict of interest. If so, it goes disclosed. We talk about it out loud with the client. We make sure that they know that, hey, I'm telling you this, and I'm going to be compensated for it, and then the decision is theirs. But we'll certainly let it be known to clients.
All right, JD. So when I personally think of a financial planner, and there's some other people that might think this, are you trading stocks every day, like day in, day out, like
Sure.
someone would on Robinhood? Or I guess, what are you doing in the background? I know you're doing the whole plan and kind of reverse engineering, but what does the actual investment look like?
Sure. So every firm is going to do this differently, Alec. We talked about hedge funds, for example. One of the strategies in a hedge fund might be high frequency trading, or it might be derivatives, options, futures, that kind of stuff. And that requires a very deep understanding of markets. The difference here is that what you're suggesting is, are we traders? The answer is no. Cameron Downing, we are investors, right? So we are looking to capitalize on the long-term returns of any given corporation. We're not looking to make our money based off of price action, right? So watching the market slide last week, 1,000 points for the Dow, for a high frequency trading hedge fund, maybe taking a short position at that time was prudent. And then you took it on the way up on Thursday when the markets soared. That requires knowing when that's going to happen, right? And understanding that at any point in time as a trader, there is a buyer and a seller. And there could be a seller or a buyer on the other side of that transaction with way more money than you could ever dream of. They will move the market against you. Even though your trade, the logic was phenomenal, your analysis was spot on, the market is a living, breathing organism that can at any time move against you. Which is why you have to be prepared for, with very high reward comes very high risk, right? So it's not uncommon for traders to be immediately wiped out, right? Whereas as an investor, a properly diversified investor, and we can touch on that more in a second, but as a diversified investor, are my accounts ever going to go to zero? Well, the assumption then is that all of the underlying stocks and companies that you're holding all go bankrupt, right? So that's a very high unlikelihood, right? From when we're talking about calculated risks. It is a lot likelier that I, as a trader, am wrong on a particular trade. Chances of that going wrong versus asking myself, is the US economy going to be in a better place in 10 years? If the answer is yes, which I believe so, then buying and holding for the long term is, in my opinion, the way to go, right?
Sure.
For example, we talk about let's use the S&P 500 as an example. The S&P 500, over a 1-year holding period, your probabilities, so if you're just a gambler, your probabilities of being positive are like 64%, right? If you go out to 3 years, it's 78%. And if you go out after 5 years, it's like 97, 98% probability of you being positive. A lot of different ways to go about that, Alec. But as a trader, the onus is on you to know exactly when to buy and when to sell, right? Whereas as an investor, the day-to-day price action is kind of irrelevant. It's more, what are the projected returns many, many years down the line. So we're not getting anybody rich quick. That's the premise. That said, if you missed out on last week, for example, and you sold on Monday because everything that day was there was a recession coming, the Fed missed the boat, get ready because it's coming, where were those people on Thursday? The market ripped 2.5%, 3%.
Up 2.5%.
Yeah. So everything that happened on Monday,
kind of undid.
Almost made it all back by Friday.
Sure.
By Friday, it was almost all back. If you had panic sold on Monday, your returns for the rest of your life are going to be very different, even if you just buy in today and hold, because you missed out on a big day.
I was reading a book, so I don't know if it was the David Swetson book or I read Reminiscence of a Stock Operator too. I forget who that's by, but great book. And it said there's typically like 4 or 5 days of the year
That make your returns.
that make like
100%.
90% of your returns or something. So if you miss those 4 days out
Your
of the year,
returns
you're
are
trashed.
Gone.
So that
Gone.
was a super interesting thing because David always talks about don't time the market, just get in, all these things. And then
Time
to hear
in the market versus timing the market.
yes,
Right.
and then to hear that in that book was an incredible thing to hear, and it made me realize I was like, wow, this is really a long game.
For
like
sure.
It's if you miss those 4 days, you're done.
Yeah.
Interesting.
Building wealth is boring, Alec. It should be boring.
It is boring.
It's boring, man. It's not what social media feeds you. I'm telling you, 90%, I will put my hand to the stove, 90% of traders are unprofitable, and they're the same ones telling you, buy my course and this is how you'll be profitable. So the conflicts of interest in the financial gurus and financial advice givers on the internet and on social media, it is so far from the truth at times, and it is of highly conflicting, again, when those interests don't align.
So just for the audience, because and for me, so when I think of financial planner, I always thought of like trader.
Right, the financial advisor that everyone's like, what's going to happen tomorrow in the market?
Yeah.
Or what company should I buy
So
today?
a lot of people are incorrect in that assumption because a lot of you guys do not trade.
Right.
You do not trade like that.
I think the majority of RIAs are not in that business, for sure.
So that's interesting. I think that needs to sit well with the audience. I think they need to understand that and process that. And I have now, after talking to you, is like, okay, it's no longer financial planner, trader.
Right.
Two wildly different things.
Very
I
different.
now understand that, so thank you. On top of that, can you talk a little bit about like the ETFs that you
Sure.
invest in and where that goes and how it's all structured and all those good things?
Sure. So we were talking about trading, right? More often than not, the traders that you're seeing left and right all over your feeds are trading derivatives, things like options, things like futures.
What are derivatives, options, and futures?
So derivatives encompass both options and futures, right? And an options contract, for example, without getting too technical, is I'm going to buy a contract from you to buy, which entitles me the right to buy typically 100 shares of whatever position we're trading at X price, where the premise is I buy this right to buy shares at, let's use easy examples, 100, NVIDIA's trading at $100. I think that by this day, it's gonna be at $110. So I'll buy a call option. Hopefully it goes my way. And in a couple of weeks, I can then exercise that contract and buy 100 shares of NVIDIA at $100, but it's trading at the market at 110, 115.
So you profit the $10
So I profit
per
the
share.
10, assuming I have the capital to buy 100 shares.
Yeah.
What most people do is they just trade the contracts. They're very volatile.
Oh, so they buy the It's essentially wholesaling real estate, but
If
you wholesale
will,
stocks.
correct. Yeah, that's actually a really good analogy. It's a really good analogy.
So for
It's a really
the
good
audience,
analogy.
I think that's okay. So options is wholesaling.
Well, let's not draw that hard parallel, but there's certainly a lot of similarity. In derivatives, you can buy that contract and it goes to crap, right? And it is, if let's say NVIDIA is not worth more than $100 on the day that I stated,
You lose money.
all of my money. The contract
All of
is
it?
all of it. The money, the contract is deemed priceless. Worthless. So you lose your premium because who's going to buy, Alec, on, let's say the market's closing on Friday, the option expires on this day. Who is going to buy the right from you to buy NVIDIA at $100 if I can get it in the market for $98, $99? Your contract is worthless.
But why wouldn't you just lose the difference? Is there a difference in there or no?
So
that
this is
make
where we
sense?
get into the math of derivatives that gets really, really complicated. But the bottom line, Alec, of why trading can be so much riskier than holding an ETF, for example, or being an investor is because some of the instruments that are used can very quickly move against you. And your contract can be worth literally $0 if the scenario that you put money on didn't work out, essentially. Okay? So that's trading, that's options. Futures is similar but different. You can trade futures around the clock, right? You can do futures trading 24 hours a day. So now you can be a real degenerate at all times of the day. Whereas what we do, we are long-term investors, right? Why I understand wanting to make money. I understand wanting to make more money than the money that you've made. But if I told you that everything that you've told me that you want out of your life can be accomplished with a 5% rate of return, why swing for the fences when a bogey will do? You don't need to take on that extra risk if all you need is a 5%, right? And that compounding is the beauty of all of this, right? In trading, I think the burden of being wrong is a lot more expensive than it is in a diversified portfolio. So to your question earlier, there's a lot of different ways, a lot of different instruments to buy or get exposure to. Let's use a company like Apple, for example. I can buy the security, I can buy shares of Apple. I can buy, historically, what was more common were mutual funds, right? What is a mutual fund? It is a basket of stocks, right? Of stocks and other financial instruments. The financial industry then came out with a second iteration called the exchange traded fund, right? So a couple of key differences here. A mutual fund is not as tax efficient as an ETF might be, right? So say Alec gives me $1 million and I put it all inside of this mutual fund. I am no longer the one making trades with all of the different securities that are inside of this basket of the stocks. The mutual fund investment manager is making those calls, right? And when they trade and they buy something and they make a little bit money, that's a capital gain. If they make money and they lose, if they buy something and lose money, then that's a capital loss. All of those capital gains and taxes and all that stuff gets sent out to the investor at the end of the year, right? Or as they're realized, rather. An ETF is a lot more tax efficient in that because of how it's structured, because of the share redemption process and some of those differences, an ETF, you can buy an ETF that holds Apple, and if the ETF at any point, if the fund manager chooses to sell that position or buy something else, there are no capital gains distributed to you. There are only when I sell that ETF. Now, that's with some caveats. Again, it depends. You might get 1099 income. You might get a K1 distribution through an ETF. It's important to know those, when you're going into a fund. But typically, ETFs are a lot more efficient. And they're also more liquid, right? A mutual fund, if you go to buy a mutual fund, the order is going to sit there until 4 o'clock, the market closes. They're priced at net asset value, at NAV. ETFs are the same, but I can buy an ETF during the market, during trading hours and sell it within the same day, which is why you have, is a very interesting conversation for another time, Alec, but the proliferation of derivatives, of traders.
What does proliferation mean?
Sure. So with the big increase, with the popularity, the traction that trading derivatives and all of that stuff has the amount of following, the amount of money that moves in through these instruments, I think has caused some pretty noticeable changes in that glide path, that return experience that we've talked about. Heck, if I have a minute, I'll explain to you what happened last week Monday. Last week Monday, the market dropped. Everybody was in panic. It was coming off of the heels of weaker than expected unemployment numbers. So the Federal Reserve has two mandates. It's purchasing power, inflation, and job security, or full job status. So there was this trade that imploded over the weekend, right? So what happens? Japan and their yen, right? The carry trade, as it's called. So Japan and their yen is 0% interest rates for a very long time, very, very long time. So any savvy investor, right? The risks that we talked about, you said, I'll buy this property, take on this leverage, and flip it for XYZ dollars. Somebody made that same call, and they were like, I can borrow money at 0%. And how it started was, I'll borrow money at 0%, and then I'll put it in T-bills, making me 3.5%, 4%, 5%, and I'm making everything in between, right? And when you have leverage, you come in with $1 million, you come out with 10 million yen, right, or whatever the conversion is, but that leverage makes it so that your losses and gains are amplified, right? I mean, leverage does that to markets. We've seen so much leverage in that yen trade that And I said, people, the smarter trade would have been, I'll borrow money at 0% and I'll put it into something real steady eddy, where I'm gonna make money off of this. What happens is that the market and its overvaluations, it's been a little stretched. We've gotten a correction, which I think is beneficial, but the market valuations were through the roof, right? And the market just kept going. And people were like, man, at what point does the Magnificent Seven, cool off and the rest of the market, broaden out, catch up? And it just didn't happen. And people just kept piling into the Nvidias, the Apples, the Microsofts of the world, the Metas, all those big names that we all know. And then it went sideways. The market started moving against these traders, so their profit starts shrinking, and then Japan raises interest rates. And that causes
Sell-off, right?
a sell-off.
Because they go from 0% to what, 3%?
25 basis points is what they jumped up to, but
25
the losses,
basis points?
Yeah, is that what Japan raised it to? I don't remember, but they raised rates.
Yeah.
And when you have leverage and when you do that math, then that small difference is a loss of 20, 30% to you, like this, right? So these people were, jumping over each other to get out and sell on Monday. And then the market was like, well, wait a minute, now we're oversold. And then it moved back. So I think leverage has definitely changed the market's dynamics a little bit, and we saw that on Monday. It was just an undoing of a ton of leverage, which is, again, why I keep coming back to being an investor versus being a trader, right?
Sure.
If you want to get into building assets, whether it's through real estate or whether it's through investment portfolios, I think diversifying, if you do not have that knowledge, and there are people out there that have 1,000 times more knowledge than you do, who dedicate themselves to this every single day and still get it wrong. Why would you be any different? Is kind of my philosophy there. So buying an ETF, buying a mutual fund is a great way to buy a single share of a financial instrument, but simultaneously getting exposure to a lot of different names.
Sure.
A lot of different names. Where if Nvidia came back from 140 traded down to 100, you've got a well-diversified portfolio. Hopefully that's not costing you all of the returns, right? Because the traders out there in the world, simple math, right? If I lose 50% on my $100 investment, it doesn't take a 50% gain to make that back. You need to make 100%.
Yep.
So it's a lot harder to come back from one of those deep losses than it is to come to terms with, I'm not going to put all of my money in this calculated risk. It's an outsized bet, but I'm comfortable with it. I think there's better ways to achieve returns that get you to where you want to go without having to take out all that risk, without having to take out all that leverage that could very quickly go, move against you in a way that does not work like the rest of market.
So JD, what's the hardest thing that you've ever been through?
Look, Alec, I was telling you this earlier, man. I'm blessed. I really am. No outsized struggles in my life. I have a lot to thank for my parents giving me the platform to, even as first-generation immigrants, get ahead in life. But being a business owner is hard, Alec, is hard. I would say that is, at this stage of life, my daily battle. You never know where the next dollar is going to come from. You never know what your day looks like. Granted, there are some repeatable kind of events and tasks and whatnot, but trying to grow a business, trying to, from the ground up, make a difference, impact people's lives positively, but also be profitable along the way. I think it is the most rewarding thing that I've ever taken on, but it is certainly the hardest. Certainly the hardest.
I think there's a lot of entrepreneurs and business owners that watch this too, so
sure.
A lot of us can attest with you. I'm right there with you, man.
Well, look, I'll
crazy.
tell you very quickly, Alec. Growing up, right, we were okay, right? My family was okay. I've never had to struggle. I've never worried about, are we going to eat, right? My parents came from Cuba. That was a question that they battled with sometimes. And thankfully, I have them to be grateful for that I've never experienced that. But I knew that money was a question mark sometimes, right? And my dad came from Cuba, started his own business. He's in telecommunications. My mother works at for their transplant unit. But for the most part, getting started in this country, I grew up around that and I saw the battles that they faced. And I knew that that wasn't going to be me. So I set out and I said, I'm going to study money. Just going to study money. And eventually that turned into, I've now studied it enough where I think I could help not just myself and my family, but others. And that's why I love what I do. That's why, although it's the hardest thing I've ever done, I wake up every day excited to tackle whatever's next, because it is a very rewarding career, and doing it for yourself just makes it that much better.
And just for the audience again, you live in Coral Gables, right?
Yeah, right down the street from you, just down Cortez, so not too far.
Nice.
We'll have to grab a
awesome.
cigar soon at Galeano's.
Absolutely. All right, second question. What motivates you? You talked about getting up.
Well, that's it, Alec. That's it. You know, it comes back to, like, if you were my client, I would ask you the same things. Why, right? Why? And I'll ask you 10 times. Why? We want to unearth those motivating drivers for clients. And what motivates me is, as I've said, coming from, again, and I don't want to exaggerate this, but coming from the XYZ struggles, right, the ones that we burdened, knowing now how to overcome those and do better, and then sharing that with other people. I'm telling you, the qualitative gain that clients get from having a plan in place and having that, again, people's lives, financial lives are so fragmented, right? People are like, oh, my house and my stock portfolio and my taxes and my insurance. I want to pull all of that together. And from that, you have a springboard to make confident, very clear, very informed decisions. And I think that is worth every single penny that clients pay us. Our objective is to have them walk out of our office saying, that's the best money I've ever spent. And we often hit that mark.
That's awesome.
We often hit that mark. And when you hear those stories and you hear and your client calls and says, we need to sell the portfolio, we're going to finally buy that house, it is so worthwhile.
That's
so
awesome.
worthwhile.
Understood. That makes sense. And lastly, what's your favorite food?
Great question. This is easy. Churrasco, sweet potatoes mashed, and that's a staple.
What's churrasco?
Churrasco is a skirt steak. Growing up, I had an Argentinian friend who defended himself very, very well in the kitchen. And any opportunity we had, a couple of dollars scrounged together, was to buy churrasco. And yeah, skirt steak, medium rare.
Well, JD, thank you so much for coming on.
Alec, thank you for having me, man. It's been a pleasure. We'll have to do this again.
Absolutely. I'm going to put some information down below here. So
yeah,
if
absolutely.
If you're watching this on YouTube right now, you can reach out to JD here.
Yep.
I'm going to put your website.
Yeah, you can definitely check us out on our website. Happy to connect with anybody on LinkedIn. That's mostly where I do my social media. And if I can ever be a resource to you, Alec, or to your audience, a quick message, or if you'd like to schedule a consultation through our website, you can do that as well.